Hi, so today we'll be doing the problem sets for the first chapter. And when I first covered uh, the first two chapters, I did the questions as well. But the questions after some point, I started to generate through AI. I'm guilty of that. So yeah, basically, I have the answers in a Google Doc in front of me on my laptop, and I'll try to verbally answer all the questions which don't require any calculation. And if they do require some calculation, then I'll pull out a piece of paper and or even a notebook and do the calculations in front of the camera. And if the question is too hard, then I'll just refer to the solutions that are there. And hopefully, if I can do this beyond chapter 2, maybe even 3, I don't know, maybe 3 also I did the questions for, maybe not, but if I can do beyond those, like if I can be consistent with this, then eventually I will just every question I'll try to attempt on my own first, and then I will look up the answer and sort of see what the official answer is compared to what I said or found out, etc. So that'll be the format of doing these questions. Before this, I was just reading the text, and after each section or paragraphs or whatever, I would explain it. And now it's a little bit of a different format since it's a question problem solving sort of video. So yeah, let's begin. I need to take out a notebook for this. Today, let's just do it on a piece of paper for this. Tomorrow, I'll buy a notebook for the purposes of solving questions from this book. So yeah, the first question is, financial engineering has been disparaged as nothing more than paper shuffling. Critics argue that resources used for rearranging wealth, that is bundling and unbundling financial assets, might be better spent on creating wealth, that is creating real assets. Evaluate this criticism. Are any benefits realized by creating an array of derivative securities from various primary securities? 1 second. So yeah, my roommate came in, so I had to cut the video. But yeah, let's resume where we were at. The first question, financial engineering has been called as nothing more than paper shuffling. Critics argue that resources used for rearranging wealth, that is bundling and unbundling financial assets, might be better spent on creating wealth, that is creating real assets. Evaluate this criticism. Are any benefits realized by creating an array of derivative securities from various primary securities? So the criticism that derivatives and financial instruments are just paper being moved around and changing hands in different forms and not really creating anything productive definitely holds some weight. However, the futures market and creating those mortgage-backed securities and collateralized debt obligations allowed millions of people to buy homes, which of course now that we look back on it wasn't such a great idea. But if people, especially bankers, were not as greedy as they had become, then who knows, maybe the situation wouldn't have become as bad as it did. Anyways, I feel that yes, focusing on creating real assets which have some basic intrinsic value and productive value would be of a better use of resources. But then again, for companies and banks, the derivatives market, especially options, is like advanced educated gambling, and the chance to make hundreds of millions of dollars just seems more profitable and attractive than something like investing in a real asset like a farm and waiting for it to grow and pay off, etc. It's just a case of greed and excitement to win big in a short time. So this answer actually I wrote by myself. So I don't really know if it's like correct and everything official or not. But that's what I wrote. So and like the next answer is a like chat GPT. So we'll be fine for the next question. This was just a personal thing that I wrote. So yeah. If this question was given in an exam, I don't know if I would have gotten full marks. I would have gotten few marks, but not full marks. But yeah. The second question is, why would you expect securitization to take place only in highly developed capital markets? So the answer is securitization. Um, securitization is more common in large capital markets due to several factors that make it easier and more appealing to conduct these transactions there. So the first one is scale of demand and supply. Large capital markets have a higher concentration of investors and institutions with sufficient demand for securitized products like mortgage-backed securities (MBS) and asset-backed securities (ABS). This large pool of participants allows for a significant capital flow, which is essential to create liquidity for these complex structured products. Number two, sophisticated financial infrastructure. Securitization requires a strong regulatory framework, advanced legal structures, and the expertise to structure, rate, and distribute securities. Large markets, such as those in the US or EU, provide this infrastructure, making it feasible to handle complex and layered financial products that smaller markets may not have the resources to support. Yeah, okay. Third point is institutional investor base. Many investors who buy securitized products are institutional, such as pension funds, mutual funds, and insurance companies. These institutions tend to operate primarily in major capital markets where they have better access to diversified and sophisticated assets. Regulatory and credit rating support. Securitization benefits from well-established regulatory bodies and agencies to ensure compliance and maintain investor trust. Large markets typically have credit rating agencies and legal precedents that help in assessing and managing the risks associated with securitized assets. Capital efficiency and risk diversification. Big markets also offer risk diversification benefits due to a wide array of underlying asset classes and a large volume of assets available for securitization. This enables originators to reduce capital costs and improve balance sheet efficiency by transferring risks to investors. These factors create an environment conducive to securitization, making it a tool more often found in large, well-developed financial markets rather than in smaller or emerging markets. So that was the second question. Third question is, what is the relationship between securitization and the role of financial intermediaries in the economy? What happens to financial intermediaries as securitization progresses? Securitization and financial intermediaries have a dynamic relationship because securitization can both complement and disrupt traditional intermediation by banks and other financial institutions. Reduced role of intermediaries. Traditionally, banks act as intermediaries by holding loans on their balance sheet and bearing the associated credit risk. When securitization progresses, banks and other intermediaries often package loans like mortgages or car loans and sell them to investors as securities, which transfers the risk off their balance sheets. This reduces the need for intermediaries to retain these loans long term, potentially decreasing their role in direct lending. Okay. Yeah. Okay. So we were basically talking about, like, in the securitization food chain, we learned that the initial party which lends out the loan, the home loan, uh, pawns it off to a bigger intermediary, a bigger bank or something, and then that bigger bank has all these groups and, like, collections of thousands of home loans, etc., of mortgages and stuff, which carry some default risk, though it was very low before the crisis, obviously, and never did anybody think that the housing market would collapse like that. So the risk was low, but it was still there. And also, like, in terms of getting a return, it took a long time, because these loans were typically over, like, 2 or 3 decades. So what they would do then, they would sell them to investors as securities, as mortgage backed securities, which would then transfer the risk of the balance sheets. So basically, whatever little default risk there was of those loans failing, and their not being able to get anything back of that loan, they would just sell them to investors, and thus, like, decreasing or even ending their loan, not their loan, their role in this whole process. So this is what we're talking about, like, reduced role of intermediaries. Second point is increased liquidity and capital. Securitization allows banks to convert, like, illiquid loans into liquid assets. By selling these loan-backed securities, intermediaries can quickly raise capital to originate new loans, effectively increasing their lending capacity without having to hold large amounts of capital against the loans. This cycle boosts the overall liquidity in the financial system, often making credit more available to borrowers. Risk distribution. Financial intermediaries typically bear credit risk when they lend. However, with securitization, that risk is distributed among various investors who buy the securities, which can make the system more resilient in theory. However, it also means that intermediaries are less directly exposed to creditworthiness of borrowers, sometimes lending to riskier lending practices. Fourth is profitability shifts. Securitization can create new revenue streams for intermediaries through fees associated with the securitization process, such as loan origination, servicing, and structuring fees. However, it also decreases the revenue from interest income, since the loans are no longer on the bank's balance sheet, shifting profitability from long term interest to short term fees. When securitization becomes highly developed, financial intermediaries transform from direct lenders into more of an originate to distribute model. In this setup, they focus on originating loans specifically for the purpose of securitizing and selling them, potentially leading to reduced emphasis on credit quality and a higher dependence on securitization markets for revenue and liquidity. Fourth, if there were no financial instruments or markets per se, then the availability of funds would be extremely hard to find for businesses, and therefore it would be very tough for small or medium scale businesses to acquire funds and grow their business. Oh no, this is the fourth question. Wait, let me read the question first. Yeah. Fourth question is, although we stated that real assets constitute the true productive capacity of an economy, it is hard to conceive of a modern economy without well developed financial markets and security types. How would the productive capacity of the Indian economy be affected if there were no markets in which to trade financial assets? Ta-da. Okay, so in this, it's basically sort of like a flipped version of the first question. So the first question was asking that, it was saying that, what do you like? What do you think about the critique that, financial assets are just a bunch of paper shuffling, and, it's practically, it's nothing. It's creating nothing. Doesn't have any intrinsic value, etc. Whereas we should focus more on creating and growing real assets which have intrinsic value. But in this question, it's sort of flipped. They're asking that if a country did not have any financial assets and only had real assets, what would be the state of the country, and, like, you know How would the productive capacity of the Indian economy be affected if there were no markets in which to trade financial assets, etc.? So that's what it's asking. So I've written that if there were no financial instruments or markets per se, then the availability of funds would be extremely hard to find for businesses and therefore to be very tough for small or medium scale businesses to acquire funds and grow their business. Therefore, if these financial instruments were not available, then that would negatively impact the productivity of India's real economy. So this is actually, I should have put this in the first question's answer, because it explains perfectly the role of financial assets. The role of financial assets is essentially to make it easier for people to improve their standard of living and also to grow their economy, their national economy. Because if somebody like, say, you know, a Sachin Bansal or something had an idea, but there was no financial market, and the only people who had money, who were like the super rich or whatever, they were in a club of their own, uh, which, let's say hypothetically, this Sachin Bansal didn't have access to. So in this scenario, in this hypothetical case, he wouldn't be able to create like Flipkart, you know, and if he wouldn't be able to create Flipkart, then all the thousands of jobs that eventually created would not exist, and therefore so many livelihoods would be taken away just because financial markets didn't exist, you know. So I would say financial markets are just as important as real no sorry financial assets are just as important as real assets, but they both complement each other. And for an economy to be a successful and growing economy, it has to have a good balance of both, in my opinion. So yeah, fifth question is firms raise capital from investors by issuing shares in the primary markets. Does this imply that corporate financial managers can ignore trading of previously issued shares in the secondary market? Okay, so this is asking if a company has been previously traded in the secondary market, and um, if financial managers can ignore that fact. So the answer is no. Financial managers still care about how and at what prices the shares are being traded at, even though they don't directly involved, even though they're not directly involved in the trading themselves. This matters to them because the prices that the stock is being traded on reflects the following: stock price as a signal. The stock price in the secondary market reflects how investors value the company. Corporate managers watch this closely because it signals market sentiment about the company's future prospects, financial health, and management performance. A higher stock price also tends to increase investor confidence, making it easier to raise funds in the future. Cost of capital. A company's stock price in the secondary market influences its cost of equity, which, if shares trade at a premium, the company's cost of equity is generally lower. A low stock price, however, could increase the cost of capital and make future equity financing more expensive. Shareholder satisfaction. Financial managers are often incentivized to maximize shareholder wealth. By considering secondary market trends and share price performance, they can make decisions that help keep current investors satisfied and attract new ones, supporting the firm's long term growth. Acquisition currency. If a company wants to use shares for acquisition, a higher stock price means it can issue fewer shares to fund the purchase, which is less dilutive for existing shareholders. So there we're basically talking about existing information, and why would any financial manager ignore any relevant information to the shares of the company that he's supposed to or about to buy. So any competent financial manager, any investor would do what's called due diligence and research and read and study and learn as much as you can about the company that you want to invest in or that you think would be a good idea to invest in. So yeah, that is pretty much that, and those are the 5 questions we're going to do today. And we will do a few more tomorrow and a few more the day after till we complete the problem sets, which there are 19 questions from the problem set, and then there are a few questions from an Indian perspective. So this is interesting questions which we'll cover, and then last page is a solution to concept checks. So then we'll be done with chapter 1 in, I'm assuming, maybe 4 days, maybe 5 days it'll take, but it doesn't matter because as long as I'm doing this almost daily, like as frequently and consistently as possible, I will finish this book, and then yeah, we'll see what happens after that. So that's it for today. Thanks for watching again, if anybody ever watches this.